So when people first start investing in the Nigerian exchange, one of the biggest decisions is whether to buy individual stocks or to buy what we call an ETF, which is an exchange traded fund. Now, both of them can be profitable, but they reward different types of investors. So, what is an ETF? An ETF is an exchange traded fund. It is a type of investment fund that trades on the stock market just like ordinary shares. So instead of buying one company, for example, an ETF allows you to buy a basket of investments in a single transaction. For example, you can buy one share of Zenith Bank. You can buy shares in Zenith Bank PLC, and you only own Zenith Bank. But if you're buying like the Stanbic IBTC ETF 30, that means you own a small portion of about 30 of Nigeria's largest companies because the ETF tracks the NGX 30 index. So think of it this way. A stock is one fruit, but an ETF is a basket of fruits. And yes, there are advantages to ETFs. Instant diversification. They always tell us diversify, diversify. ETFs gives you instant diversification because you're buying a plethora of stock, not just one. Okay, so it has lower risks because it is diversified. It has lower risks than owning a single stock, and it is managed automatically to follow an index or an asset class. So in the case of the example, we use the Stanbic IBTC 30. That one is following the NGX 30 index. Okay, it is ideal for long-term passive investors. Unlike stocks that you have to monitor your stocks from time to time, an ETF, you really don't have to do that much work. And it usually has lower management costs than mutual funds. I was actually surprised when I found this out, but I think it is good for us to know. Everything that is managed, there are funds attached to it. And an ETF, most ETFs actually charge way lower than most mutual funds. But what are the disadvantages? Because for everything that there is an advantage, there is a disadvantage. One of the major disadvantages is that the returns are limited by the overall basket. So if there is a particular stock that did extremely well, but that stock is not in that basket, you would of course not enjoy the benefits of that. So your returns are limited by what is in the ETF basket. You won't capture the explosive gains that a single exceptional stock can produce. I just mentioned that. And you will still pay management fees, unlike when you're buying the stock. So, are ETFs what's the trouble? Well, personally, I tend to prefer a not too active um, behavior when it comes to investing. I have a full-time job. I have a full-time job. Even making videos on social media, YouTube and the rest, it's not my full-time job. It's something I do by the side. So I work in a faith-based organization. I run a training school. I do not have the time to actively manage my investment. So yes, an ETF is actually a good addition to my investment. So let's compare Nigerian ETFs with Nigerian dividend stocks and see if it is better to actually invest in an ETF or to invest in dividend stocks. Now, for this comparison, I looked at the strongest performance over approximately 12 months based on recent NGX data and fund reports. So everything I'm about to share with you is public knowledge. I don't have any secret knowledge anywhere. Everything is public knowledge. Now, because Nigerian ETF market is relatively small, we have just about a dozen listed ETFs. The comparison includes the major funds that have delivered the highest price appreciation. Okay, so that's what we're looking at, the funds that have actually delivered the highest price appreciation. So recently, however, recent year ETF prices have experienced an unusual volatility in 2026 because of certain things that happened with the NGX in 2026 that a lot of us are aware of. So let's look at the top performing ETFs in Nigeria based on our data for the last 12 months. At the very top of the list, which surprised me when I started going through this data, was Vetiva Commodities ETF. The signal is VCG ETF. That's how it appears on your apps. So the approximate return is in the past 12 months about 118%. 118%, and the investment focus of this ETF are commodities. Now, when we're talking of commodities, we're talking of things like cocoa, we're talking of things like oil and all of that. So those are commodities. Now, the next one, which actually surprised me because I still do not understand how they did it. And I wish I knew about it before I started making this video, but now that I know, we'll go there now. Okay, it is the sorry, I have to look at my notes. Is the SIAML pension ETF. And it made approximately 185% yet in 12 months. In 12 months. So what is that from June last year to June this year? 185%. And it is a pension-oriented equity basket. So a word of caution though, the gains reflect an exceptional market move reported during the 2026 bull run and does not really represent sustainable long-term investment. So yes, the bull run really did crazy things for people. So the next one is the New Gold ETF. New Gold did 60% from last year June to this year June, that's 12 months, and they focus on gold. That's the only commodity, so it's a gold investment. We have the Lotus Halal ETF, and those ones did 64%. And these actually deal with Sharia compliant equities, which I am very much interested in because anything that will give me money, I'm interested in it. And then we have the Vetiva Griffin 30 ETF, which did 45% in 12 months, and it tracks the NGX 30. Now, this is exceptional data. So we know that the ETF market has produced surprisingly strong returns because of Nigeria's equity rally. Like, we all saw the bull run this year, and it was crazy. So most ETFs, have been following the market instead of outperforming it, but these ones actually outperformed the market, as we can see. So I would like to compare, since we're doing a comparison, between ETFs, owning ETFs and owning dividend-paying stocks. I would like to compare some dividend-paying stocks, like how has the price appreciated in the past 12 months, and if they actually pay dividends. So I think the number one company that we'll look at is GTB, Guaranteed Trust Holding Company. And in the last 12 months, they have done approximately 220%. Or some people say it's about 180%. But okay, let's say 180% to 220%, which is that the price has appreciated almost 200%. And it has an excellent dividend reputation because it pays dividends. This one, I have friends that own it. So when they were receiving their dividends, dividends, that kind of thing. And of course, there's Zenith Bank. You'll notice that we're going to talk a lot about banks because one of the reasons for the bull run, for the strong equity rally, was actually the recapitalization of bank stocks. So Zenith Bank has done about 170% in the last 12 months, and they pay dividends. Their dividend reputation is excellent also. Fidelity Bank has done 250%. Okay, this I did not know until I started this research. 250%. Like, if you bought Fidelity, let's say you bought Fidelity 10 naira, so now it would be like 25 naira or so, or 35 naira. I'm not even that good in math. So I think that's crazy. In just 1 year, 12 months, and they do pay dividends. So we have UBA, which has done about between 140 to 180, and yes, they pay dividends. And we have Presco. Presco is the only non-banking, dividend stock in this list, and they have done 150% to 200% in the past 12 months. So you see this discrepancy, you see the difference. It's mostly because the stocks rallied, and then we had a bear run where people were taking profit. A lot of us took profit, and the share prices dropped. So that's why you're seeing between 150 to 200%, and their dividend reputation is excellent. So if I were to do a head-to-head comparison of ETFs versus dividend stocks, what do I look at to choose? I mean, I'm building my portfolio, right? So what do I look at when I'm building my portfolio to know if I should invest more money in an ETF or if I should buy single stocks, single dividend paying stocks? Now, when it comes to diversification, we know that ETFs, the diversification is excellent because you have a bundle of equities inside your investment fund. But dividend stock, unless you own a lot of them, your diversification is very poor. How many dividend stocks can you buy with your 10,000 naira a month? But then you can put it in an ETF. I'm just saying, I'm not giving you advice. I'm just telling you the pros and the cons. So we have risk. Of course, owning an ETF, the risk is lower because of diversification. But owning individual stocks, the stocks can go up, the stocks can go down. So it is kind of risky. The risk is higher with owning individual stocks. We have the potential upside. Well, ETFs will rise moderately, but we know equity can do 200%, like we have seen in our comparison earlier. So yes, in this dividend stocks, if picked properly, actually have a higher potential high side than ETFs. Dividend income for ETFs is kind of moderate, it's capped, and but for dividend stocks, it is usually higher than ETFs anyway. The amount of research that you need to put into it in order to choose the best ETF or to choose the best dividend stock. And when it comes to ETF, it's very low because our ETFs in Nigeria are not even that plenty. You can just read their fact sheet and you know everything about it. But when it comes to dividend stocks, you have to invest in knowledge. You have to know how to read the balance sheet, how to read income statement, and all that in order to pick the best stock for your portfolio. Time commitment, we're very busy people. So ETF wins on that one because very low. Just invest and forget about it. But when it comes to dividend stock, you have to do a lot of other work associated with it. So the end product is how suitable are these for beginners? As we can see from our head-to-head comparison, ETFs seem to be more suitable for beginners because you don't have to know a lot about all the stocks. You just have to know the fact sheet about the ETF. But when it comes to dividend stock, you have to do a lot of research, a lot of work. So if you're a beginner, I would suggest, sorry, I'm not giving any advice. I would suggest that you start with ETFs instead of buying dividend stocks. So before we round up this video, the question would come, of course, which has produced better returns in the past 1 year? Well, if we're looking at the data purely for the past 1 year, the best performing individual dividend stock has generally outperformed the best performing equity ETF. So there you have it. Yes, a few specialized ETFs posted spectacular gains, but they were exceptional rather than typical. So traditional ETFs actually deliver lower but steadier returns than even the very best banking stocks. And I got that quote from Nairametrics. Yes, I watch Nairametrics. So if I were building a Nigerian portfolio today, if I were building a portfolio today, what would I do? For those of you who have been following me on this channel, you know I'm not much of a fan of individual stocks. I prefer funds where I don't have to do so much work because I am a very busy person. So for long-term investors, for those of us who are building our pension plan simply because we don't have employer-based pension, I would suggest that you invest more in ETFs than in individual stocks at the beginning. ETFs will give you a feel of investing, and the individual stocks will tell you which commodities or which stocks you actually like and which ones you don't like. And when you're now rebalancing your portfolio, you'll be able to tell, okay, I like this kind of stocks, I will invest more in this type of company. But if you're just building it so that you can be reinvesting your profits, you're investing your dividends automatically and all that, I would say start with an ETF, then eventually start including some individual funds because I intend to include individual stocks rather to my portfolio this year. I've already started doing it, started buying the dip. So both ways, as you can see, both of them have their pros, their cons, their benefits. So you will do what works best for you. And remember, when it comes to investing, it is not taking advice from those of us that are on Facebook or YouTube or wherever. Yes, we're giving you advice based on what we know. We are telling you our stories, we're giving you suggestions based on how much we know. It is left for you to do your due diligence. So you do your due diligence and continue to reinvest your dividends. And that is the only way you will grow sustainable wealth. Yes, this has been a long one. I really do not do videos that are beyond 10 minutes, but this has been 14 minutes, and I hope you have found it to be enlightening. So if you have, you can click that subscribe button, like, share, leave a comment below ETFs or single dividend stocks, which do you prefer and why, and I'll see you in the next one.